Welcome to This Explainer. Today, we're tackling one of the most dangerous and honestly most expensive misconceptions in the trucking industry today. We're breaking down trailer interchange insurance. Look, if you're an owner-operator, a leased driver, or running a power-only business, you are likely pulling trailers that don't actually belong to you. And there's this massive, incredibly common assumption out there that could literally bankrupt a small trucking business overnight. So we're going to clear up the confusion, look at the real-world numbers, and make sure you've got the exact knowledge you need to protect your livelihood. Let's dive right in with the quote straight from our source material that really serves as a massive wake-up call. Quote, "You don't own the trailer, but if it gets damaged while in your possession, you could still be responsible for tens of thousands of dollars." End quote. The absolute biggest mistake truckers make is assuming, hey, the trailer isn't mine, so the owner's insurance company will just handle it, right? Wrong. If you're using someone else's equipment under a specific agreement, that financial responsibility shifts entirely onto your shoulders. And we are not talking about pocket change here, over $80,000. That is a staggering out-of-pocket cost you could personally owe if a borrowed trailer overturns, burns to the ground, or gets stolen while it's under your control. Modern trailers, especially the specialized ones, are incredibly expensive pieces of equipment. One accident, just one theft, could create a repair or replacement bill that completely wipes out your profits for the entire year, or worse, shuts down your business for good. All right, Section 1, the hidden trailer trap.
So here's the crucial distinction, and really the trap a lot of folks fall into. Most drivers think their primary liability insurance has their back for the whole shebang. But actually, primary liability only covers the damage you cause to others, like if you hit another car or damage a guardrail. It absolutely does not cover physical damage to the borrowed trailer you're pulling. To protect the trailer itself, you need trailer interchange coverage. They are two completely different shields for two completely different risks. Moving right along to Section 2, what is interchange coverage?
Okay, before we even talk about the insurance, we got to talk about the contract that makes it necessary, the trailer interchange agreement. This is a legal, binding contract between trucking companies that lets them exchange, pull, or temporarily use trailers they don't own. When you sign this, or when you operate under a carrier's authority that uses them, this agreement legally transfers the responsibility of that equipment right to you. It's super common in drop-and-hook operations, power-only trucking, and intermodal freight. The very second you hook up to that trailer, its safety is your financial burden. And this brings us to a huge point of confusion. A lot of truckers mix up trailer interchange coverage and non-owned trailer coverage. So what's the difference? It all comes down to the paperwork. Trailer interchange coverage specifically requires a written, formal interchange agreement to be in place. If you're just, say, temporarily borrowing a trailer from a shipper occasionally without a formal written contract, well, that falls under non-owned trailer coverage. Knowing which bucket you fall into is absolutely vital, because having the wrong policy means your claim's getting denied.
Which brings us to Section 3. What is actually covered?
If you're paying for this policy, you need to know exactly what risks are shifted away from your wallet and onto the insurance company. Trailer interchange coverage protects against physical damage to the non-owned trailer. We're talking collision, fire, theft, vandalism, and overturns. Back into a dock a little too hard, severe weather damages the rig, you're generally covered. But listen to this. It strictly covers the physical trailer itself. It does not cover the cargo inside. For that, you need separate motor truck cargo insurance. It also doesn't cover liability to others, and it definitely doesn't cover trailers that you actually own yourself. Let's put this into perspective with a real-world scenario. Imagine you pick up a refrigerated trailer owned by another company, and while you're out on the road, the unthinkable happens. It jackknifes. The damage is severe, and the repair cost comes out to $45,000. Now, the owner isn't going to just let that slide. They're going to demand payment from you. Without interchange coverage, that $45,000 comes straight out of your pocket. With it, your insurance steps in to handle the repair costs. Here's another all-too-real example. It's winter, the roads are slick, and you slide right into a ditch with a borrowed reefer trailer. The physical trailer takes some hits, sure, but worse, the highly sensitive and wildly expensive refrigeration unit is completely destroyed. Boom, that's a $38,000 repair bill. Because reefer units are so specialized, their repair costs are just astronomical. If you don't have the right coverage, you could be facing a massive lawsuit from the trailer owner just to recover those funds. All right, Section 4, costs, limits, and risks. Let's talk numbers. So what does peace of mind actually cost? The average yearly premium for trailer interchange coverage usually ranges from about $200 to $1,500 a year.
Now, why such a big gap? Well, underwriters look at a ton of different factors to figure out your risk. They're looking at your driving history, your accident record, your operating radius, and, this is key, the types of trailers you pull. If you are exclusively pulling highly expensive reefer or tanker trailers, you can definitely expect to be on the higher end of that premium scale because the risk to the insurance company is just significantly higher.
Now pay close attention to this because this is where folks really get burned: the out-of-pocket gap. Buying minimum limits just to save a few bucks on your premium is incredibly dangerous. Let's say you buy a minimum policy limit of $30,000, but the reefer trailer you're hauling is worth $85,000. If you total that trailer, your insurance pays out the 30 grand max. That leaves a massive $55,000 gap. And guess who is personally on the hook for that remaining 55 grand? Yep, you are. Choosing limits that actually match the value of the equipment you haul is completely non-negotiable.
Let's quickly review the fatal assumptions that regularly lead to lawsuits, collections, and contract terminations. Mistake number 1 is thinking your primary liability covers the trailer. Mistake 2 is signing interchange contracts without realizing you just accepted total financial responsibility. Mistake 3, as we literally just saw, is buying low limits that leave huge exposure gaps. And mistake 4 is assuming the carrier you're working with just magically covers everything. In trucking, ignorance is not a valid defense, and trust me, insurance claims adjusters agree with that. You have to verify your responsibilities.
Let's wrap things up with Section 5, protecting your trucking business. Here's your game plan. Before you haul a single burrowed load, you need to have a serious chat with your insurance agent and demand clear answers. Ask them point blank, does this policy include reefer trailers? Because those often require stricter underwriting. What is the exact coverage limit? What deductibles apply before the insurance actually kicks in? Are the trailers covered if they're temporarily detached from my tractor? And, most importantly, does this specific policy satisfy the exact interchange contracts I'll be signing? Always get these answers in writing. And on your end, out in the field, you've got to build a rock-solid paper trail. Insurance companies investigate claims thoroughly. They look at maintenance records, driver negligence, you name it. So protect yourself. Inspect every single trailer carefully. Snap date-stamped photos before hauling to document any pre-existing damage. Verify your contracts. Carry the proper limits. By strictly following these best practices, you establish a paper trail that prevents major claim disputes later on and ensures your insurance actually protects your livelihood when you need it most. Ultimately, I want to leave you with this critical question to ask yourself right now. If disaster strikes your borrowed trailer today, who pays? Because finding out that borrowed trailers are your responsibility after an accident, a fire, or a theft, that's way too late. Hoping for the best is simply not a business strategy. Take a hard look at your policies, talk to your agent, and make sure your trucking business is protected from the hidden trap of trailer interchange liability. Thanks for joining me on this explainer. Keep the rubber side down and stay safe out there.